If you are a franchisee who owns multiple units and you are planning to sell your business and retire in the next 5 to 8 years, you may be thinking to yourself, will I run out of money in retirement? How should I invest my money differently after I retire? And how much can I safely withdraw from my portfolio each year? In today's video, we'll take a look at how to structure your portfolio withdrawals after you sell your business to never run out of money. If you are new to the channel, hi, I am Ruzanna Queenan. I am a chartered financial analyst and the founder of Queenvest. And in the many years of advising entrepreneurs and franchisees on their retirement, I have developed specific planning methodologies to help you create a safe plan to have enough income throughout your retirement while also maximizing your lifestyle and the enjoyment of your retirement. So let's dive in. There are 4 strategies that I recommend you consider when you are planning to retire. And those strategies are the bucketing strategy, the systematic withdrawal strategy, the passive income strategy, and the charitable strategy. Each one of these strategies has a pros and cons, and the strategy that you choose in the end will depend on your specific needs. And when I meet with retiring franchisees, we go deeper into their specific situation to determine the right strategies for you. But to give you an overview of these strategies and help you to start thinking about which one would be right for you, we'll take a quick look at each one of them. The first strategy that I would like to consider for you to consider is the bucketing strategy. With this strategy, you divide your money into 3 specific buckets. In the first bucket, you put enough cash and cash-like instruments to cover about 1 to 3 up to 5 years of expenses right after you retire. These are the expenses that you want to have covered in cash because you don't want to be in a situation where the markets move against you, there is a lot of volatility, and you have to withdraw too much money from your retirement in the first initial years of retirement. So once that amount between 3 to 5 years of expenses is safely invested in something like money markets portfolio or CDs or individual bonds, then you can look at the second bucket, where you allocate about 3 to 10 years of expenses into the market, but into a more predictable, less volatile section of the market. What can go into this bucket could be bond portfolios of different maturities that will provide you specific level of income over the years, or income producing balanced stock portfolios. And the next bucket is where you actually allocate your money for growth. This is the amount that you know you will not need in the next 10 plus years. And what you want to do is invest this money into a stock portfolio so that your retirement wealth can continue to grow and it will last you many years. These days, when we project retirement lifetime, we project for you to live up to 95 years because of longevity. So what we want to do is make sure that you have enough money for all of those years. The next portfolio strategy that I'd like for you to know about is the systematic withdrawal strategy. And there are 3 flavors of the withdrawal strategy. The first and most straightforward one is withdrawing certain percent of portfolio each year. So that could be 4%, 6%, 8%. You basically take the portfolio that you have and withdraw 4% of your total portfolio value, and you live on that money for a year. Here, you should be very carefully consider 2 things. Again, this portfolio can be a little risky if you are implementing the portfolio withdrawal strategy at the very beginning of your retirement and there is volatility in the markets and the portfolio value is dropping. So you don't want to, this may have a negative consequence for the rest of your retirement. And you also want to carefully consider which investments to sell first so that, again, you don't overpay in taxes and you don't jeopardize the rest of your retirement. The next portfolio strategy that addresses some of the shortcomings of the withdrawal rate strategy is actually the flexible guardrails that align your withdrawals with the markets. So with this strategy, you set up specific guardrails of the minimum and maximum amount that you can withdraw, and you are more careful budgeting and managing your spending. And you look at your experience in the markets and you say, Okay, if the markets rise more than 20% in a certain year, you may have a little more discretion and you can afford to take a little more money out of your portfolio in a particular year. While if the markets are down 20%, what you do is take less money out of your portfolio in a particular year so that again, you manage the longevity of your portfolio smartly. And the next withdrawal strategy that we want to look at is the floor and upside strategy. Here you look at several sources of income that you may have in retirement. The first and foremost is your Social Security, which you will have even after you've owned business for many years. And it may not be a significant percentage of your income in retirement, but it's something stable and predictable that you can count on. You may also have pensions that either you or your spouse may have earned before you started your business. You add up all of these sources of income. Here you can also have the annuities you may have purchased. So once you determine how much stable fixed income you have, you want to make sure that these sources of income cover your basic expenses, and then everything else that you need for your lifestyle, for travel, for helping kids and grandkids, or doing things that bring you enjoyment and fun in retirement, then you look at your portfolio to cover those expenses. So that's basically the budgeting strategy and the systematic withdrawal strategy. The next strategy is probably one of the most traditional strategies, and that is your passive income strategy. Here you depend on income from your assets, from your investments to cover your expenses. The simplest and the most straightforward one is the interest that you gain from bonds and possibly private debt. Maybe you have loaned privately to a business or to a company, and you can live off of the interest that these instruments provide. So with this strategy, with a degree of certainty, how much interest you will be earning each year from these investments, and when your investments will mature, so that when you get your principal back, you are able to reinvest that principal into the next set of interest-producing investments. The next source of income is the dividends. Here you invest your money in income portfolio that has high-yielding dividends. So a lot of stable, mature companies that have predictable cash flow like to return money to shareholders, and they have monthly, quarterly dividends that actually grow over time to again gain that confidence among their investors in their success and also reward long-term investors. So with these companies, you are receiving these quarterly dividends, monthly dividends or quarterly dividends, and you can structure your budget according to the amount of dividends that you are expecting. And last but not least is investing in real estate syndications. I feel that real estate income is a great way to diversify your portfolio and draw extra amount of income. And typically when retirees think about the real estate portion of their portfolio, they're thinking about parental properties, to buy a house, to buy a property, rent it out to tenants and collect rent from these tenants. I consider that too much work in retirement when you just want to enjoy your time. What you can do is invest your money in a real estate syndication, become an investor, a limited partner in a fund that buys multi-family units and apartment buildings, and the property management company will do all the heavy lifting, all the work to collect the rent, and will send you a check every month from those rents. And eventually, when the property is sold, you will also participate in the appreciation of the property. And then again, you can reinvest the proceeds in the 7 to 10 years when this fund actually has an exit. The next portfolio strategy that I'd like for us to look at is the charitable strategy. And this one needs to be right for your situation. If you have family, if you have children who are interested in taking over the business, you may have an estate plan that helps you transfer and transition your business to your kids. But if you're in a situation, if you're a single owner of multiple units and you have plenty of income and you're thinking about legacy and you have causes and charities that are important to you, you can structure your portfolio and your retirement in a way that is a win-win for you and also for the charity. You set up what we call a charitable remainder trust. Basically, you transfer the ownership of your business into this trust and you actually take an income tax deduction based on the projected remainder of your asset of your business. And then within that trust, you can sell the business, create a stable portfolio, and have a certain level of income every year from your portfolio. And then at the end of your lifespan, whatever the value of the portfolio is at that time passes on to the charity. And that way you have an enjoyable retirement, you travel, you have a lifestyle, you help your extended family. In the end of your lifetime, you create a lasting legacy. So these are the 4 strategies that we looked at. And again, the strategy that is right for you will need to be based on your goals, your situation, and how you want your overall retirement to look. From many years of helping franchisees retire, what I have determined is that success in retirement has less to do with how much you have saved and more with how well your retirement spending strategy is structured. So if you are looking to optimize your retirement, I will be publishing videos to this channel every Sunday. So check back often, and I will see you soon.